it's my pleasure and it's an honor to be here. Thanks you and also the authorities to invite me here, which gave me the opportunity to meet such an exclusive public. I'm going to give a little bit touch how we just can deal with modeling issues. And Moika has already gave some numbers, and it seems that in our session we are going to complete our information in rows. So I'm very happy to see that that's going to be a kind of complete session as well in terms of catastrophic risk insurance. So I'm going to skip some of the slides fast because some of them are already mentioned, and also I would like to give more time to discussion if any comes. So, I mean, the very basic thing from the recent history is that the Hurricane Andrew, which is hurricanes, as you know, with the satellites, everything can be, just you can foresee that something big is coming. And of course, which area is going to hit. Therefore, there is a kind of more or less estimation and of that catastrophe is going to have an impact. And the estimated losses was 13 billion, and the actual losses were 15.5 billion. Therefore, just for a very well-developed insurance system in United States, these 2.5 billion caused the bankruptcy of 9 insurance companies. So catastrophic risks based on the natural disasters are really catastrophic. So I'm skipping those, just you know that there is a huge impact of the natural risks on the budgets, not budgets of the governments, on the insurance companies, but the individuals as well. Even if the natural risk does not hit to your region, your home, you are indirectly getting a touch of it. So that is the big issue for all parties. So what are the components of a hazard or natural disaster and pricing it? So there are 4 components which are hazard, what kind of hazard, how we can get the specifics of this hazard, and the inventory, which means that how much property financially is going to have create a loss, of course the lives as well, which is going to give us the vulnerability. So the vulnerability is a good tool to come up with the monetary amounts, which we call as the loss or the loss amount. Therefore, the characteristics of the disaster, when we talk about the earthquake, its magnitude, its location, epicenter, and relevant parameters are the consideration of the earthquake engineers and related areas. For example, for the hurricane, its projected path and the wind speed is going to give us what kind of hazard and impact it might have. But if it hits to a nature having no buildings, no human residency, then that's going to have a natural event. But if it's going to hit to a highly developed industrialized or the metropolitan, then that's going to require that what is the maximum loss which might happen in terms of the portfolio or the inventory as well. Therefore, based on this information, what is done that the earthquake engineers, they create the vulnerability or the susceptibility to the damage curves that is going to give us how many percent is going to have an influence from a certain natural risk. So, of course, what are the indicators for those is that the severity parameter, like in earthquake, it can be either the peak ground acceleration or the velocity, or for the hurricane, for example, peak gust wind speed. So the measurement and it's going to be in terms of if there exists a certain level of the earthquake, how vulnerable is going to be your inventory. Okay, so the loss could be direct or indirect. And the key challenge is how can we allocate the catastrophe risk, which is less frequent but more extreme, in a similar manner as the other insurance products. So, of course, the main thing is that less frequency makes difficulty to come up with a good modeling. So when we talk about the modeling, you do you have lots of room, space to get an information. You can use many analytics to come up with how many % of this type of properties has a damage and how much is that related to that, yielding from percentuals to kind of statistical distributions with certain parameters. But when you look at the history, all these natural catastrophic events has so specific different characteristics, which also does come up with different behaviors. So it does make also difficult to come up with a better fitting models. So the main question, what should be the premium rate? So they should require a sufficient demand. Who is going to buy if there isn't enough public to buy it? Even though they need it, after an earthquake, 1 year, 2 years later, the people say that, yeah, but just it happened and it's of course not going to happen in a very near future. So that's one of the big issues. And how can you constitute a cash inflow of the revenues to cover the expenses on a given catastrophe and still doing that, still yielding a net positive profit over a pre-specified time horizon? So the estimation of the frequency of the catastrophic event is the most probably losses based on the catastrophic modeling, and the exceedance probability curve gives us what is the probability that the loss is going to exceed a certain amount. So this is the basic case, basic information that the insurance companies, reinsurance companies take into account. Now I'm going to talk about how probabilistic approach to calculate the premium for an earthquake case. So the premium is going to depend on the expected annual damage ratio, which is nothing but the mean damage ratio multiplied by the seismic hazard or the likelihood of the event. Then, of course, when you look at here, this likelihood of the event changes with respect to the intensity or the magnitude of the earthquake. Therefore, the mean damage ratio is going to depend on what is the likelihood, the probability of a damaged state with an intensity I is going to happen with a central damage ratio. So these look like just these formulas, look like complicated, but they are nothing but the weighted averages. Now, what we mean by the probability, damage state probability. So if you are a civil engineer, you can just describe the state of your property after an earthquake or after a natural hazard. Nothing happened, light damage, moderate damage, heavy or collapsed. So the damage ratio is going to be, if you have an inventory, how many of them is going to be allocated within those states. Then based on those, you just come up with an damage matrix, which is going to allow us to define these weighted probabilities, weighted averages. Then the premium, the risk premium, is going to be the insured value. You are come up with a weight or a percent on the flow of all these algorithms, and you are going to set the premium as much as your property values. So this is the probabilistic seismic hazard approach to calculate the premium. So, of course, if I come up with this premium, so how I'm going to deal with the portfolio. So it's not only one single unit, it's regionally or spatially distributed set of portfolios. Therefore, risk management is very important. And in the risk management, the main thing is that the risk diversification is not all the time possible because there is an interconnectivity, the dependency, if you consider only with some subsample or a certain location. Therefore, the risk transfer is a very important tool in here, and we, of course, deal with reinsurance. So, in the reinsurance pricing, which I'm going to give you an example that we did with one of my student and a colleague from Portuguese, that the experience rating and the exposure ratings are two approaches. And the companies, they mostly consider the exposure ratings based on some exposure curves. So the experience rating requires that you should have the data on the written premiums and the incurred claims. And just that to get rid of the extremely XL cats, you just give an upper bound on the losses which comes up from the catastrophic risks. And based on this information, you estimate the future claims and the premiums. Whereas in the exposure rating, the historical experience risk profiles are taken into account and just take into the consideration that your claims come up with a certain statistical distribution. You find out based on the sum insured, maximum probable loss and expected maximum loss, the total exposure. How is it going to work? Now, this is the simulated case, and based on the simulated case, we assume that the catastrophic losses or the claims come up with, let's say, distribution X, like normal distribution, for example. And then you just rank them from the smallest to the largest. The sorted claims ratio is going to give you an information where do you locate based on a certain loss ratio. Therefore, here, if you just set a deductible of a certain amount, then you are going to see that what is above the excess of the losses is going to yield to you, to your company. So, okay. So it's not moving. I guess I ate up the old energy with it. Okay, so here is an example. The total losses constitute the 5% of your portfolio, and the 60% losses, I mean, this is a very famous curve, which is called the Swiss Re curves, one of the examples. And this one says that what percent of your portfolio is prone to what percent of the loss ratios. Therefore, here, this allows us to find out if you do have the 60% of 30%, this means that you have a partitioned loss curve, which is going to give you what will be your acceptable deductible amount to face with a certain amount of loss ratio, so that your portfolio is going to have, and for example, risk of having this losses. So the average loss ratio is, let me try again, yeah. The average loss ratio is 0.32, or the 32%. Then 32% losses in your portfolio is going to be constitute the 60% of your portfolio. 25% loss ratio is going to constitute the 20% of your portfolio. So that's an important indicator. Where should you cut off your deductible? Okay, in the reinsurance pricing, as I say, Bernegger's suggestion, whose example is given in here, gives us an opportunity to work on certain deductible amounts and just make a decision to play with it. Okay, so here is the Bernegger's loss ratio or exposure ratios says that it depends only one parameter, which makes it easier to estimate. And based on those parameters, you see that the higher the loss ratio, then you become more diagonal. So with I'm going to skip this example, but you are going to have an access to the slides. This is very much related to what I have explained. Together with one of our colleagues, we have done, you are in only one risk here. When you consider about the excess claim amounts or claim ratio, it's only based on one risk line. What if you do have the second risk line? So we have studied that if you do have dependent risk, like fire and earthquake, if you do have, for example, landslides and earthquake, so how these curves are going to behave. And this one has been produced. So I will talk about shortly cat bonds and findings about the cat bond study. Of course, this is a financial market instrument which gives a kind of breadth to the insurance and reinsurance companies. So it's nothing like a financial or bond, or it functions as a coupon bond, but having a certain specifications. So it is available through a special purpose reinsurance vehicle. And the insurer purchases from this mediator and pays the premium to the same entity. And he holds the premium and sells as a bond in a trust, invests the fund in a treasury bonds or higher yield assets. Therefore, how it functions? The insurance firm establishes a special purpose vehicle, sells to the investors, and it proceeds in a collateral account, and if it's specified, and with a very high interest, why somebody should buy a cat bond? It pays relatively high rates, help diversification in the portfolio. So what happens if there is no earthquake, the trigger, what is called? The natural hazard defined onto it. So if there is, so you are on a plus and earning a good interest. What happens if the event occurs? Then these funds are withdrawn to cover the losses. So it's again very much depending to the mutual agreement. You might get your initial fund, or you may not. Most probably, it's utilized to pay out the losses. So how do the cat bond pricing is made? So the very famous three-parameter lane model is used, which is the composition of the, here is the probability of first loss, the conditional expected loss. So these are not, I mean, very technical things to you, and which comes up with a Cobb-Douglas function. So it is nothing but a nonlinear form which does have into account the maximum losses and the probability or the likelihood of the possible losses, average loss, maximum loss. So that's all available in the data set. So the price of the cat bond is very much resembled from pricing a regular bond. So the total coupon rate to investors, this the LIBOR percent and the spread. So what is spread? As you all know, spread is nothing but the deviation, the risk standard deviation. Therefore, what we have done is that with my former student from Freiburg and colleague, we just studied the cat bond data from 2001 and 8, and just to see that if a natural catastrophic event is discouraging buyers to invest on the cat bonds or not. So that was the main purpose. So we have just gotten the data, cat bond data, its yield, and how much it's paid and so on, and calculated the annual expected loss, probability of first loss, conditional expected loss, and risk load, and adding the appearance of the Katrina as a dummy variable, and also adding the rating to the bond. And just I'm going to mention what we have found out. The increase in cat bond supply after the hurricane or Katrina lead to a reduction in the spreads, and the conditional expected loss increased significantly after Katrina, and the expected severity of the cat bonds weight is increased by the investors. And the correlation structure completely changed because the trigger of such an event has just changed the approach of the insurance and the reinsurance companies. And the investment grade rating from BB or BBB to BB plus has changed with respect to the amount of the conditional expected loss. And we have seen that the linearized function proposed by Lane is doing much better than the nonlinear Cobb-Douglas form. So this is just how you just come and determine the outcomes of reinsurance as a risk transfer and cat bonds as a financial risk transfer, and very simple analysis to that. So emerging markets, when we say that what are the properties, lower than average per capita provides actually rapid growth, and this is an advantage for the investors, but results in high volatility. And resulting in high volatility, having no deep financial markets, is very much prone to collapse in the financial dynamics as well. So what is the government role? I mean, natural catastrophes is all the time big load burden on the governments. Therefore, then, even though you have an insurance, many of the coverage of the insurance, they do not enough to cover the post-disaster losses. I'm just going to give only 2 or 3 slides, if I may, about an PPP structure, which is very successfully working in Turkey. I'm sure you have heard of it. I'm not going to come up with all details. Turkish Catastrophe Insurance Pool is initiated after the 1999 earthquake. And so Turkey is a very high seismic risk-prone country, established in 2000. And again, the main problem, it took 12 years that the requirements of this scheme come up as a decree law. And it considers only the residential buildings, and the aim is to release the burden on the government budget. Okay, I dropped this. The main characteristics that informs, it is the affordable premium, alternative risk transfer, and reliable distribution channels. You use the whole insurance sector, and you make the enforcement by real estate registration office, mortgage credits, and electricity and water subscriptions. So the structure is that the Treasury, now the Ministry of Finance, there is a board running the whole system. There is an operational manager, which is one of the insurance companies, and all the other insurance companies, they function as an agencies. And operational manager is responsible of reinsurance, fund management, IT management, public relations, and loss adjustments. So, and I'm just going to skip those. In the reinsurance, the claim capacity is 4.3 billion. And we have globally distributed reinsurance agreements. Cat bonds, in 2013 we had the cat bond associated to TCPI, and 2.8 million euro excess of loss reinsurance, and the 82% of the deposit and the other one, 18%, is the government bond, and its value is 1.29 billion for the time being. And here is the information about the cat bond issued by the Munich Re and GC, and the 2015 Munich Re, Swiss Re, and the GC securities. And here you can see the details of the Turkish catastrophic cat bond. So I would like to finalize just that catastrophic events will appear more and more with high severity, because how we are actually consuming our world with bad urbanizations, with air pollution or environmental lack of attention to the environmental and all the other impacts that we can think of. So the main issue that really who should take care, should take the responsibility of it. Governments, this is too big, may not be enough. Insurance companies, they are, of course, the profit-oriented organizations, which are really doing a huge good for the public, and the individuals who is not going to be able to handle by himself. So the combination of three, the main public awareness is very important. As we have mentioned and talked with many people, it's the most difficult product you can ever sell. Whatever, I mean, an insurance product, whatever it is. So there should be a government interference and encouragement with that. So thank you for your patience.
Thank you, Sevtap. Wonderful presentation. Let me ask you, in Turkey, there is any new momentum regarding to the microinsurance maybe, or inclusive insurance, or it's not an issue, or there are some incentives?
As far as I know, I mean, microinsurance would be most considerable in the agriculture insurance. But after the establishment of TARSIM, the agricultural pool, it is actually not very much considered. But I'm not the correct. I mean, I'm not the regulatory side. But as far as I know, the volunteer agriculture insurance is doing really good, even though it's voluntarily, because the main living essence of the farmers is what they produce. Even though if they do not have any education on insurance, they know that somebody is going to pay even a little bit if they just invest to the correct channel. So it's really the awareness among the farmers is very high, especially a month ago we had a huge hurricane type of storm in Antalya region, which really destroyed a lot of the greenhouse productions, and the insurance mechanism worked very well. And they see that it's paying, and they continue taking it. But microinsurance in agriculture as a branch is not known to me at the moment. It's not considered.
Okay, thank you, Sevtap.